it's hard for banks to see the upside. But from a risk perspective, FRTB is one way or another forcing banks to up their risk game.
The global financial crisis of 2008 brought the global financial system to the verge of collapse. It impacted people's jobs, it impacted people's ability to get loans, people's ability to mortgage their houses. Part of the problem was that banks didn't have sufficient capital buffers during the credit crisis, and this put the entire financial system at risk. FRTB is essentially a system of rules to try and better protect the real economy from risky trading behavior by banks.
FRTB is the single biggest piece of regulation impacting banks since 2008. The reason being it will completely revamp the way banks calculate their market risk capital requirements.
It's forcing every bank to raise their game from a risk perspective, no matter where they are. To comply with FRTB, banks need to put in place a data and analytics backbone that will do the specific calculations that the regulators require that are inside all these formulas. But that same backbone can also then be used for much more than the capital calculation. It can be used for risk modeling, it can be used for transparency, and it can also be used for communication of risk across the organization. FRTB focuses on a few different things. One is data, right? So making sure that you're using data inputs to describe your holdings and classify them accurately. For some complicated mortgage-backed security, I'm not allowed to say, oh, this is just a AAA rated thing and I'm done, because I have to classify it and run it through models in a way that's more accurate from a data standpoint. Requirement number two is, in terms of modeling, is making sure that you align the way that you represent your securities and their risks with how you're actually trading them, how you're actually pricing them on the desk level.
Every bank has to follow a standardized approach in order to calculate their market risk capital requirements. On top of that, some banks may choose to opt for the internal model approach, which requires approval from the regulator and works at a desk level.
Banks are going to have to decide, do they want to take a standardized approach or do they want to take an internal approach? Both represent different challenges. For the internal approach, they'll have to produce a lot of data to show that their models work to regulators. And for the standardized approach, they will have to implement parameters given to them by regulators to monitor their risks and to assess their bank's asset profile against a sort of series of simulated shocks.
The advantage of the standardized approach is its relative simplicity, given it's standardized. The disadvantage of the standardized approach is a higher capital charge, generally speaking. Internal model approach requires banks to have sophisticated risk models. It is heavily data intensive in terms of the data you need to ingest into your model and the computation you need to run on a frequent basis. On the other hand, internal model approach can help banks to reduce their overall capital charges. FRTB requires a lot of data for banks in order to be able to fulfill both the standardized approach and the internal model approach. Reference data, pricing data, fund holdings data, regulatory data, historical data, multiple different data sets are required. The challenge for banks with FRTB is to remain compliant over time. Once you've acquired the necessary data, the necessary analytics to be able to implement on day one, it remains important to calculate capital charges on an ongoing basis. Also, the rules might change over time. It is important to have the right providers, both in terms of data and analytics, so you can take the long-term approach for compliance.
FRTB has been an industry discussion point for the best part of a decade now, and it's been subject to various delays, revisions, interpretations, debate. We are finally approaching the point where major jurisdictions have in place final legislation to actually see this thing through. The important thing to know here is that FRTB is a global standard, but it's being applied on an individual jurisdiction level. Different regulators will have different expectations, different working practices, different starting times. The bank should be mindful of differences between their obligations in different jurisdictions.
People should care about FRTB because it's ultimately about the stability of the financial system. Every bank that plays a role in the financial system is going to have these guardrails in place, and then the regulators can be confident that the whole system is a little bit more secure.